Um, I'm with the Daily Market Report. I produce the Daily Market Report every morning and a nightly stock report with both trading picks and swing picks every night. So today I want to talk about what caused the buying panic on Monday and whether there's more to go. Following Friday's S&P Following Friday's S&P close over the key 2520 to 2530 level, a buying panic broke out in many of the former leaders in the bull market. Names include our old friends Twilio, Team, MDB, Lulu, Wayfair, Roku, which we had on the radar both Friday and Monday, and Five, just to mention a few. Remember that 2530 was the heart attack low back in February, so this made it a key level. A broad array of stocks, along with the former leaders I mentioned, were up smartly across the board, but they were up much more than the S&P futures would have dictated. What was the buying panic on Monday about? Well, you've got to remember that many money managers and fund managers use the futures to hedge, but their jobs aren't to pick the direction of the market or time the market so much as it is to create a portfolio of stocks. These money managers are required to be nearly 90% invested most of the time, unless they are designated market timers. So, from my perch, it looks like Friday's thrust, on the heels of Fed Chair Powell's second reversal in as many months, caused a change of heart amongst money management committees who probably met over the weekend. Clearly, a decision was made to deploy money. The problem was, with stocks jettisoned indiscriminately by ETFs in December, there was little stock overhead to be had, causing an air pocket. The likelihood is these money managers had dialed up pullback levels on stocks in their crosshairs, but when the market failed to pull back in the late into Friday's huge range on Monday morning, a buying panic broke out. It looks like the S&P futures, which pulled back half of the day's range into the runoff, may have been used to hedge as stocks failed to give up ground, with fear of missing out trumping the tape once again. Now what? Can the market go higher directly from here? We're going to take a look at the S&P dailies and weeklies to answer the question. But first, to recap the way I've been looking at the market, Friday's report noted the Nas may be on a rocket to 7,000. Another good day like yesterday and we'll be there. The question is whether 7,000 is dead ahead, or will the vicious volatility that is whiplash traders hit before potentially higher levels are struck. Then yesterday's report showed a weekly S&P flagging the likelihood of a backtest of the neckline of 2018's big Head and Shoulders top. Let's take a look at that. So here's your left shoulder, your head, and your droop right shoulder, and here's the neckline below which caused the Christmas crash. While I think the S&P may indeed be poised to backtest this neckline on trade just above 2600, it's around 2620, sooner rather than later, it probably isn't going to do so in a straight line. Why do I think that? Because listening to the mainstream financial media yesterday, the idea of an immediate run to 2600 has become extremely popular very quickly. And what everybody knows on Wall Street usually isn't worth knowing right at that time. So I suspect a detour if 2600 plus is on the table, and possibly a big one. Here's why I think so. The S&P, I'm going to go back to the dailies. The S&P has satisfied a nearly 50% retrace of the Christmas crash. Here's your December 3rd high. Here's the Christmas Eve low. That high was 2,800. 2,800 and change. The low was 2346 for a range of 454 points. Half the range gives 2573 to 2574. Monday's high on the S&P was 2566 right here, and it looks like the index is going to kiss the 50% level this morning. If the S&P can push above this 50% retrace of December's range, the monthly range, then it may reach the upper level of this rising trend line, which we're going to show more clearly on the hourlies. It may reach it, and it may reach it quickly. However, importantly, 50% of the entire decline from the all-time high to the December low is 2643 in the same region as this short-term trend channel. So right in here, you have a 50% retrace of December's leg down, and at 2620 to 2640, you satisfy a 50% retrace of the whole quote-unquote bear market in line with the top rail of this rising trend channel, along with the neckline and the 50-day declining moving average. So that's going to be a real inflection point, and as I said earlier, the question is going to be whether we hit that sooner or later. Last week we said we thought the market rallied in January, so that very well could be January's business. But there's a caveat, as there usually is with the market. There's always a T-Rex in the ointment, and that is that this decline is clearly consistent with a violent third wave down, third wave decline. You can see from the high, you got first leg down, an ABC rally for a second wave corrective move, and this runaway move to the downside is clearly consistent and characteristic of a third leg down. That means that this move could be a fourth wave corrective decline, giving way to a fifth wave push to the downside that theoretically could take out this low. Sometimes you get a divergence, and that you do not get a new low. So this is why, whether we panic straight up into this level, it's going to be important to watch and not get too carried away emotionally, or whether we get a pullback from this 50% retrace of the December leg, a 3 to 4 day pullback, say, that holds this channel support and then moves up, say, into the end of January to fully backtest this trend line. This lower rail ties to 2490 to 2500, so that's going to be a level to watch. So as complacency reared its pointy little head with more chasing in the last few days, caution is warranted. If there is anything characteristic about the market of late, it's that one good air pocket has led to another. That said, last week we offered that January did look up for the market, and if a fifth wave is going to play out, it may occur after January. So the S&P and NAS have retraced 50% of their last legs down. The important thing to take note of is that 80% of the time, a 3-day spike to a 50% retrace is a short in any market. The indication looks higher into late January, but that may come after a 3 to 4 day pullback holds the 2490 to 2500 S&P support. If that plays out, they could push higher, with the S&P fully satisfying a 50% retrace of the entire bear market toward 2640. That may be an A leg. That may satisfy an A leg prior to a B leg down and a C wave up, which is part of a greater A, B, C, a B wave. In other words, if this was a big A wave down in the bear, then at some point we're going to get a B wave up to at least the 2800 level, followed by a Suya wave down, which is going to be significantly lower lows, lower than December's lows. So these 50% levels, the market is remarkably symmetrical. I never cease to be amazed at how synchronistic and symmetrical it is. The 2346 low for the move on Christmas Eve actually ties to a 50% retrace of the entire 2016 to 2018 bull run. And as we flagged last week in our daily market report, the extreme number of selling climaxes in individual stocks last week coupled, or the week last week of December coupled with satisfying this 50% retrace, precipitated a sharp rally. Range precedes price, and the S&P's lightning rod, or large range outside up day on December 26th, right here, perpetuated this sharp rally. Range precedes price, and the S&P's lightning rod on December 26th signaled higher prices. The tape looks good, but we've seen the market turn on the dime from impressive rallies many times in the last 3 months. Additionally, on the decennial pattern from 2009, this is a very important pattern to the legendary W.D. Gann, the S&P rallied 10% into January 6th, 2009 to 944. From there, it proceeded to plunge to 666 in just 60 days by March 6th. So never say never. Never say you're out of the woods. So protect your gains diligently, adhere to your stops, and don't get swept up by the fear of missing out. And think about putting on some shorts if they open up today and then turn down. Every past decline looks like an opportunity. Every future decline looks like a risk. The bottom line is, the most important lesson I've learned in my 30-year plus career is that recapturing a 50% retrace following a deep decline often means a complete retrace to prior highs and higher. So this 2643, half the range of the bear market, is going to be key. The question is when it plays out. I think it could play out as soon as January, but I also think that a 2 to 3 or 3 to 4 day even pullback down to this lower rail of this channel could occur first. Of course, that could happen. It's about 60 points lower. In this market, that could be a day and a half of trade. So good luck out there today. Speak to you later.